Welcome back to Principles of Macroeconomics. Your professor Matthew Bradbury. Today we're covering Chapter 11, Measuring the Cost of Living. In this chapter, we're going to look for answers to the following questions. What is the Consumer Price Index, or CPI? How is it calculated, and what do we use it for? Are there problems with the CPI? If so, how serious are they? How does our CPI price index differ from our GDP deflator index? How can we use the CPI to compare dollar amounts from different times? Why would we want to do this anyway? How can we correct interest rates for inflation rates? The CPI, or Consumer Price Index, measures the typical consumer's cost of living. The basis of cost of living adjustments, or COLAs, is the CPI in many contracts and in Social Security. Ultimately, what we're looking for is a price index that measures inflation for goods and services that are important to consumers. When calculating the CPI, it's just like going shopping at the grocery store. First off, you figure out what you need to buy. So step one is to fix the basket. Here, we're going to be taking the quantities and the variety of good and keep it constant every time we go shopping. The Bureau of Labor Statistics surveys consumers to determine what is in their typical consumer's shopping basket. This basket will constitute a standard of living. 2. Find the prices of the goods in the basket. The BLS collects data on the prices of all the goods in the basket. Number 3. Compute the cost of the overall basket. Here, we're going to use the prices to compute the total cost of our fixed quantity of goods. Once we've calculated the cost of the basket in various years, we can then move on to calculating the index. In order to do so, we're going to need to have a comparable base year. So, step 4 is to choose a base year and then compute our index number. The CPI in any year will equal the following equation. We will be taking the cost of a basket in our year of interest, dividing it by the cost of the basket in the base year or reference year, and then multiplying by 100 to get our index number. Once we have our index number, we can compute the rate of change in that index number in order to give us the inflation rate. We've done this before. This is simply a rate of change formula. We did it with the GDP deflator, we did it with real and nominal GDP, and now we're calculating the inflation rate as the percentage change in the CPI. The inflation rate will be equal to the CPI this year minus the CPI last year divided by the CPI last year, and then of course multiplied by 100 to give us a percent. In our next slide, we'll be doing a numerical example of this. For our simple numerical example, we're only going to have 2 goods in our basket. We're going to choose the quantities and fix those quantities for every one of our yearly calculations. We've fixed the basket at 4 pizzas and 10 lattes. We're going to calculate the cost of the basket for 3 years, 2010, 2011, and 2012. We go ahead and find the prices of our pizza and lattes. In 2010, the price of pizza was $10. 2011, it was $11. In 2012, it was $12. The price of lattes in 2010 was $2, $2.50, and $3 respectively over the years. In calculating the cost of basket, we will simply take the prices and multiply them by our quantities of pizza and lattes. In 2010, the cost of the basket was $60. This figure comes from the $10 multiplied by the 4 pizzas plus the cost of lattes, which was $2 multiplied by 10 lattes. You can see how the calculation runs out for 2011 and 2012. The cost of the basket in 2011, $69. The cost of the basket in 2012, $78. You can see that the cost of the basket is increased, but our standard of living, the 4 pizzas and 10 lattes, has been kept fixed. $60 will buy you 4 pizzas and 10 lattes in 2010. By 2012, you'll need $78 to purchase the same quantity of goods. I often ask students if they would rather have $60 in 2010 or $78 in 2012. Students that are understanding the difference between nominal and real variables are indifferent between those two options. Having $60 in 2010 is exactly the same as having $78 in 2012. Students who are focused instead on the nominal variables think that 78 is bigger than 60, and so I'd rather have 78 in 2012. This is incorrect, and it illustrates, again, this idea that rational individuals will be thinking in terms of real variables. Moving forward to computing our CPI in each year, we look to the bottom left quadrant of the slide. We're going to calculate the CPI for 2010, 2011, and 2012. In order to calculate the CPI, we need to choose a base year. Here, we've chosen 2010 as the base year. For 2010, we will take the cost of the basket in 2010, $60, divide it by the cost of the basket in the base year, also $60, and multiply it by 100. The CPI for 2010 is 100. Notice that 2010 is our base year. The CPI is always 100 in the base year. In 2011, the cost of the basket had risen to $69. Our CPI will be calculated as 69 divided by 60 multiplied by 100. Our CPI in 2011 is 115. For 2012, the cost of the basket was $78. We'll divide that by our base year cost of basket, $60, and multiply by 100, giving us a CPI of 130. We can then move forward to calculate the inflation rate of the CPI year on year. From 2010 to 2011, we moved from an index of 100 to an index of 115. This raw change of 15 divided by our benchmark last year, the CPI of 100, and multiplied by 100% gives us a 15% rate of inflation change. From 2011 to 2012, the CPI rose from 115 to 130, and this is a 13% rate of change. The inflation rate from 2010 to 2011 is 15%. The inflation rate from 2011 to 2012 is 13%. You should be getting very familiar with these types of calculations. You'll almost certainly be asked to use them on the homework and also on exams. We can take a look at the types of goods by category that are included in our fixed basket. What is in the fixed basket is revealed by this lovely pie chart. You can see that the largest component in the basket is housing. The smallest is miscellaneous other categories. We also have education and communication, apparel, food and beverages, and medical care. These are the types of goods that most consumers buy over and over and over again, and they constitute the goods in the basket. As with any measure, the CPI is not perfect. Overall, there will be 3 reasons why the CPI might be inaccurate at gauging changes in the cost of living for consumers. The first one is called the substitution bias. The CPI shopper is kind of dumb. The CPI shopper goes into the market and buys the same fixed goods over and over again. But you, on the other hand, are smart, and you might steer away from goods that have rising prices and steer towards goods that are lower cost if those goods are reasonable substitutes for each other. Thus, you're able to avoid rising prices, whereas the CPI shopper is not. Over time, some prices rise faster than others. Consumers will substitute towards goods that become relatively cheaper, mitigating the effect of price increases. The CPI misses this substitution because it uses a fixed basket of goods. For this reason, the CPI will overstate increases in the cost of living. There's going to be an upward bias to the CPI because of our substitution bias. Our second problem with the CPI is the introduction of new goods. The introduction of new goods will increase variety, and this allows consumers to find products that more closely meet their needs. In effect, the dollar becomes more valuable. This is because you can buy the variety of such a good that most closely matches that which would give you the most utility. The CPI misses this effect because, again, it uses the fixed basket of goods. Thus, the CPI will overstate increases in the cost of living. Our third and final problem with the CPI is unmeasured quality changes. Improvements in the quality of goods in the basket increase the value of each dollar. The Bureau of Labor Statistics tries to account for quality changes, but probably misses some, as quality is hard to measure. Thus, the CPI overstates increases in the cost of living. Collectively, these problems boil down to give us an upward bias in the CPI. Each of these problems causes the CPI to overstate the cost of living increase. The Bureau of Labor Statistics has made technical adjustments, but the CPI probably still overstates inflation by about 0.5 to 1% each year. This is important because Social Security payments and many contracts have COLAs tied to the CPI. Remember, a COLA is a cost of living allowance, contractually attached to some stream of payments. In the 1990s, it was estimated that the CPI's upward bias cost taxpayers $1 trillion every 12 years in unnecessary COLAs in Social Security and government pension payments. Here's our two measures of inflation that we've been looking at. We have the CPI, as indicated by the blue line, and the GDP deflator, indicated by the red line. You'll notice that these two measures of inflation, they tend to move together. In fact, fairly closely together. But there are some divergences. Let's look at some of the important differences between the CPI and the GDP deflator. Consumers, when they're shopping, oftentimes buy imported goods. These imported goods will be included in the basket of goods used in the CPI, but they are excluded from GDP. Increasing import prices will affect the CPI, but will have no effect on the GDP deflator. Capital goods. Capital goods are goods that businesses and firms use to invest in productive infrastructure. Consumers don't buy these goods, and thus they're excluded from the CPI. However, if they are produced domestically, they will be included in the GDP deflator. If you recall, the CPI shopper uses a fixed basket of goods, but the GDP deflator uses a basket of currently produced goods and services. This matters if different prices are changing by different amounts. Let's take a moment and do a learning check to see if we understand the differences between the CPI and the GDP deflator. In each of the following scenarios, determine the effect on the CPI and the GDP deflator. Scenario A, Starbucks raises the price of frappuccinos. Scenario B, Caterpillar raises the price of the industrial tractors it manufactures in its Illinois factory. Scenario C, Armani raises the price of Italian jeans it sells to the United States. And let's reveal the answers. Starbucks raises the price of frappuccinos. Well, the CPI is going to increase. It's a good that consumers use. And the Seattle-based company, the GDP deflator will also rise. Scenario B, Caterpillar raises the price of industrial tractors manufactured in Illinois. The GDP deflator will rise, but the CPI will not. This is because a Caterpillar industrial tractor would be considered a capital good, not a consumer good. Scenario C, Armani raises the price of Italian jeans it sells in the United States. These Italian jeans must be imported into the United States, so the GDP deflator will not change. But if these are part of the basket of goods for the CPI shopper, then the CPI will increase. If you got those all right, good job. So far, we've done a great job of looking at the differences between our two measures of inflation and in calculating the GDP deflator and the CPI. Once we have this data, how can we use it to enhance our ability to run analysis? One of the ways in which we will be using this information would be correcting variables for inflation. Let's move on to using our CPI. In correcting variables for inflation, we can compare dollar figures from different times. In essence, what we're doing here is going from nominal variables to real variables. Remember, we can only make meaningful comparisons about real variables through time. For this reason, nominal variables have to be adjusted for inflation. Inflation makes it harder to compare dollar amounts at different times. For example, in 1964, the minimum nominal wage was $1.15. By December 2010, the nominal minimum wage had increased to $7.25. If I asked the student the question, would you rather have a time machine and go back to 1964 with $1.15 in your pocket, or go back to 2010 with $7.25 in your pocket, which one would you prefer? Students thinking only in terms of nominal variables would prefer $7.25 to $1.15. But we have to convert these to real variables before we can actually make a meaningful comparison. Did the minimum wage have more purchasing power in December 1964 or 2010? To know that, we have to know how many goods and services $1.15 would buy in 64 and find out whether or not it would buy more or less goods and services than $7.25 in 2010. To compare these two figures, we're going to use the CPI and the rate of inflation to convert $1964 into 2010 dollars. In doing so, we'll use the following equation. The amount in today's dollars will be calculated by taking the amount of nominal dollars in our year of interest and then growing that figure at the rate of inflation between the level in time t, our past time, and the price level today. For that last term in the equation, we're going to need to have price levels today and price levels for our time in the past. We'll pull our CPI to use to calculate this ratio. So here what we're doing is we're taking an amount of dollars in past time and we're simply inflating it or growing it at the same rate as inflation. In our example, year T, or our year from the past, is 1964. We're going to consider today to be 2010. The minimum wage was $1.15 in 1964. If we grew that wage with the actual rate of inflation, then we'd have a constant dollar figure. Our CPI in 1964 was 31.3. In 2010, it was 220.3. The minimum wage in 1964 is equivalent to having $8.09 in 2010. Using our equation, what we've done is take 115 and multiply it by the ratio of the CPIs between our 2 years. Had the purchasing power of the minimum wage grown with the rate of inflation, it would have been $8.09 in 2010. In fact, having 115 in 1964 is the same, in terms of purchasing power, as having $8.09 in 2010. So in our previous slide, we said, would you rather have $7 in 2010 or 115 in 1964? And the answer is, you'd rather have 115 in 1964. In order to be as well off as this in 2010, you would need $8.09. When we are correcting variables for inflation, we often use these in research. Researchers, business analysts, policymakers often use this technique to convert a time series of current dollar or nominal figures into constant dollars or real figures. Once this has been done, they can see how the variable has changed over time after it's been corrected for inflation. Let's look at a graph of the nominal and also the constant wage, the real wage. Looking at the minimum wage in current dollars, you can see it's depicted by the brown line. It is a bit like a staircase. This is because the minimum wage is a legal price floor, and it increases only when elected leaders get together and decide that it should be mandated to increase. It changes in a discrete fashion. The orange line indicates what the minimum wage's purchasing power would be in constant 2010 dollars. What you can see is that though the nominal minimum wage has increased with these various steps through time, the real wage has actually exhibited this sawtooth pattern, largely declining over time. This is because increases in the nominal minimum wage are not keeping up with inflation. And so consequentially, the purchasing power of the minimum wage has been declining, at least up through 2010. Correcting variables for inflation, indexation. A dollar amount is indexed for inflation if it is automatically corrected for inflation by law or contract. For example, the increases in the CPI automatically determine the cost of living allowances in many multi-year labor contracts, and also adjustments in Social Security payments and federal income tax brackets. It's interesting that we haven't attached the minimum wage to a COLA. We haven't indexed it to inflation. It brings up the interesting question as to if we establish a minimum wage to protect a minimum purchasing power of unskilled workers, why wouldn't we preserve that minimum purchasing power by indexing the minimum wage to inflation automatically? What we've looked at is the difference between real and nominal variables, and we can also think about the difference between interest rates. We'll have both real and nominal interest rates. The nominal interest rate is the interest rate that is not corrected for inflation, and the rate of growth in the dollar value of a deposit or a debt. The real interest rate will be corrected for inflation and will be the rate of growth in the purchasing power of a deposit or a debt. We can calculate the real interest rate by taking the nominal rate of interest and subtracting out inflation. This is oftentimes referred to as the Fisher equation. The real rate of interest is equal to the nominal rate of interest minus inflation. Most interest rates that you see quoted are nominal interest rates. It's the rate of growth in the dollar value of some sum of money. But whether or not that increase in your sum of money is making you more wealthy or not depends upon whether or not you'll be able to buy more goods in the future than you can today. In order to preserve your purchasing power, your nominal interest rate must at least keep pace with inflation. In order to grow your purchasing power, the nominal interest rate has to exceed inflation. The real rate of interest tells you whether or not your wealth is growing or not. If the nominal interest rate is 2% and the inflation rate is also 2%, then your money's just growing exactly with the rate of inflation. You're not able to buy more goods. If the interest rate is 4% and the inflation rate is 2%, then you'll be getting 2% more wealthy over time. Again, rational individuals will make decisions about saving on the basis of the real interest rate, not the nominal. A simple numerical example. Suppose you deposit $1,000 for 1 year in some interest-bearing account. The nominal rate of interest is 9%. During that year, inflation will be running at 3.5%. What will be the real growth in the purchasing power of your deposit? In order to calculate this, we have to calculate the real interest rate. The real interest rate is the nominal rate minus inflation. Our nominal rate of interest was 9%, the rate of inflation 3.5%. Your money is growing at 9%, but its purchasing power is being eroded at 3.5%. On net, the real rate of growth of your money is 5.5%. The purchasing power of the $1,000 deposit will grow by 5.5%. Here's a visual reference for graphing real and nominal interest rates in the United States from 1950 to 2010. The nominal rate of interest is shown by the blue line. The real rate of interest is shown by the red line. Here, the nominal rate of interest is the interest rate on a 3-month Treasury bill. The real rate of interest is this rate minus the inflation rate as measured by the percentage change in the CPI. Notice that the nominal and real interest rates often do not move together. This is because of variation in the inflation rate. You may also notice that when nominal and real rates diverge greatly, it's because of high inflation. On the other hand, when the two lines are closer together, it's because of lower and possibly more stable inflation. In summary, the Consumer Price Index is a measure of the cost of living. The CPI tracks the cost of a typical consumer's basket of goods and services. The CPI is used to make cost of living adjustments and to correct economic variables for the effects of inflation. The real interest rate is corrected for inflation and is computed by subtracting the inflation rate from the nominal rate of interest. I hope you enjoyed the lecture. Have a lovely day.